Hello traders, you're welcome to this video and you're welcome back to the Forex Geek channel. If you have been in the Forex market for any amount of time, you've probably heard about moving averages, all right? But how can you use this powerful tool to identify trends and boost your trading? That's exactly what we're going to do in this video. All right. So whether you're just starting out or you're an experienced trader looking to refine your strategy, the moving averages indicator is essential for identifying market direction and refining your entry and exit points. So make sure you hit the like button, subscribe, and let us get started. First of all, let us break down what the moving averages indicator actually is. Okay, so you can be able to find this indicator. It's very common. All right, you can find this indicator on any platform that you are using. Okay, this is a very common indicator. Now, this is the moving average indicator. It is a mathematical calculation that helps traders identify trends by smoothing out past price data. The main purpose of a moving average is to filter out market noise and show the underlying trend. Okay, so it essentially averages the prices of a currency pair over a specific period of time, depending on the period that you set here. Okay, for example, if you are on the 1 hour time frame and you set the period to 20, it means that the average is going to be calculated based on 20 hours. All right, because it's the 1 hour time frame and you set it to 20 periods, it means it's going to be 20 hours. If it was the daily time frame and you set it to 20, it's going to be 20 days. If it was 50 periods, it's going to be 50 days. If it was 50 period and 1 hour, it's going to be 50 hours and so on. Okay, now the main purpose of a moving average is to filter out market noise. Okay, that's the main purpose, right? For example, a simple moving average takes the average of the closing prices over a specific number of periods. Remember that we have different categories of moving averages. Okay, we have simple moving average, we have exponential moving average, we have smooth moving average, we have linear weighted moving average, and so on. Okay, we have different types, we have the varieties, we have a variety of moving averages. Okay, now we also have but two of the most common, right? Two of the most common moving averages we have are the simple moving average and the exponential moving average. These are very common categories. Okay, the exponential moving average gives more weight to recent prices, making it more responsive to recent market movements. Okay, so traders use both the simple moving averages and the exponential moving averages, but the goal is the same: to help you to see the direction the market is heading. Now, moving averages are a key component of trend following strategies, and for good reason, right? The moving averages help you identify whether the market is trending up or down. Basically, if you have price trading below the moving average, it's as clear as possible. You know that this is a bearish trend. Sorry. When you have the price trading below the moving average, it's clear that it is a bearish trend. On the other hand, when you have the price trading above the moving average, it is clear that it is a bullish trend. So it's very easy to spot, very easy to identify. All right. Now, trends are everything in Forex, and moving averages give you a clear picture of where the market is headed. Using a moving average, you can easily spot whether the price is above or below the line. It's a very easy indicator to use, whether you are an experienced trader or a complete beginner. All right. If the price is above the moving average, it's generally a bullish signal, meaning the market is trending upwards. Conversely, if the price is below the moving average, it suggests a bearish trend. This simple but powerful indicator helps you stay in the trend and avoid trading against it, which is one of the best ways to stay profitable. Okay, in as much as this indicator can be properly useful, it does not guarantee profit. All right. Now let us talk about the different types of moving averages and how to use them in your strategy real quick. Okay. The two most common types of moving averages are the simple moving average and the exponential moving average. Now let us start with the simple moving average. Okay, I'm just going to change this to simple. All right. Now the simple moving average, or the SMA, is the most basic form of moving average, and it is easy to understand. It's simply the arithmetic average of a set of prices over a specified period of time. All right. For instance, if you are using a 20 SMA, right, it will average the closing prices And depending on what settings you put here, right? But the default is applied to close. So if you apply this to close, it's going to average the close prices of the last 20 candles. If you set the period to 20, you're going to average the closing price of the last 20 candles. All right. It's slow to react to price changes, but it can help you see the long-term trend. Okay. On the other hand, the exponential moving average, I'm just going to change this to exponential. You can see the difference. The exponential moving average, or the EMA, places more emphasis on recent price data, making it more sensitive to price changes. Now, this can be very helpful in faster moving markets or when you want to catch trends early. For example, a shorter period of the EMA, if you want to reduce the period, you can just edit this and put the period that you want. Let's, for example, the shorter period of the EMA, like 9 period, the one I just set now, the like example, the 9 period, it reacts much quicker to price than 50 period, right? So depending on the period settings, the smaller the period, the faster the price, the faster the indicator reacts to price changes, the higher the period, the slower the indicator reacts to price changes. All right. Now, in as much as both the SMA and EMA have their strengths, the SMA is better for longer term trend following, while the EMA is ideal for spotting quicker market movements. All right. So, in as much as moving averages are quite powerful on their own, they work best when combined with other technical indicators. All right. For instance, you can decide to combine the moving averages with relative strength index, or any other indicator that you feel is going to be, easy for you to understand, right? You can decide to use the RSI or any other indicator of your choice just to confirm signals. You can use the MACD, stochastic oscillator, or any other common indicator that can be easily understood. All right. Now, when you are using the RSI, for example, you just have to look out for overbought and oversold territories. When you have a signal from the moving average, for example, the price cuts above the moving average, giving you a buy signal, you watch out for the RSI. Ensure that RSI is not in the overbought territory. Ensure that RSI is trending upwards, identifying bullish momentum. It's as easy as that, right? In the case of a sell, when you have a sell signal, make sure that you look out for the RSI. Ensure that the RSI is not in oversold territory. Ensure that the RSI is trending downwards, giving you sell momentum, right? A signal for sell momentum. So it's as easy as that, okay? It's as easy as that. Now, to sum up, the moving averages indicator is one of the simplest and most powerful tools in Forex trading, all right? Whether you are using the SMA for long-term trends or the EMA for short-term moves, this indicator helps you identify the direction of the market and make more informed trading decisions. By combining moving averages with other indicators like the RSI or MACD, you can build a comprehensive trading strategy that helps you stay ahead of the market. All right. If you found this video helpful, don't forget to hit the like button and subscribe for more valuable tips and strategies. Keep learning, stay patient, and happy trading. See you in the next video.